Hi everyone, and welcome to topic 2 of accounting for managerial decisions. In this topic, we'll be looking at business transactions. Before we get into the heart of the topic at hand, it's useful to have a quick recap of what we did in topic 1. Because while some of it was just giving a flavor of kind of accounting and accounting in society, there are some really important elements which will feature in what we're going to be looking at now. So we looked at just what the accounting process is about, what accounting is, the difference between financial and management accounting. So financial accounting deals with external financial reporting, and it's a focus for the first half essentially of this course, whereas management accounting is dealing with more internal reporting, and we'll be looking at that in the second half of the subject. Touch on business sustainability. We started then looking into the regulatory background within Australia, leading into the accounting framework or the conceptual framework, which very much touches on, and importantly for us, looks at the 5 and defines the 5 accounting elements, which we'll review as we go into today because they are very important for how to deal with business transactions. And finally, we finished up with the limitations and costs of accounting information. So where we want to go to with today's topic. So we're going to describe the characteristics of business transactions, look at the process of double entry accounting or the double entry system of recording, which is what is used quite widely now. It wasn't always, but in the last 500 years or so has become the preeminent way of doing accounting. We'll look at the way in which business transactions affect or impact on the accounting equation. Don't get too scared if you don't particularly like maths. The equation is fairly straightforward when we get to it. We'll then move into, this is, I suppose, more doing in the sense. So prepare an accounting worksheet and how to create a simplified statement of profit or loss and a statement of financial position. Look at journals and ledger accounts and how they capture and sort of move that information through the system. Looking at applying debit and credit rules, and then looking at some simple transactions, what the trial balance is about, and then to wrap up with, look at how you work out where errors have crept in to the system. Now, as we go along, there are going to be some of this is going to be held within this particular video. So we will touch on a few smaller examples around how to deal with the worksheet, for example, and looking at the journals and ledger. But we will actually create a second standalone video where we actually work through a worked example in its entirety. So, this is more of a high level view of gives you the lay of the land. Whereas if you want to sort of get into the meat of it all, that will be in a second video, which there will be links for and obviously be available to you. So to start, business transactions. So business transactions are occurrences that affect the assets, liabilities, and equity items in an entity. So again, they're very clear that they're things which affect those accounting elements. And not only are they things which affect them, we can only record them under certain circumstances. So they can be recorded when they can be, and this is a really important one, they can be reliably measured. There are going to be things which, for all intents and purposes, seem, for example, like an asset. But if we can't reliably measure what the value of that particular thing is, then we can't record it. And again, as we move into looking at the different financial statements in coming topics, this will be made more clear. They also have to occur at arm's length. So there's a level of, this isn't just a purely internal transaction. So a whole range of examples there, obviously sort of, the owners can be putting capital in, payment of wages, receipt of interest, purchase of a digital camera, for example, payment of accounts payable, and a few more in there. Examples of things which aren't a business transaction, or at least one, would be shares which are traded. So if we've used Woolworths in this class. If we use Woolworths, the shares which are trading hands at the moment on the market, those share trades are not a business transaction in relation to Woolworths. Those are between parties, between one party who owns Woolworths shares and another who doesn't. And, and yes, there may be, clearinghouse in terms of the market, but Woolworths themselves, any movement in their shares between third parties doesn't affect their assets, liabilities, or equity. So that would not be a business transaction. As I said, it's important that we have a quick recap of the elements, because if we're going to be affecting these elements as part of business transactions, it's good just to keep front of mind what they are. So an asset is a present economic resource controlled by the entity as a result of past events. So again, not about ownership, it's about control, and it's something that has happened. A liability, on the other hand, is a present obligation of the entity to transfer an economic resource as a result of past events. So right at this point in time, the entity owes something. And that has happened. It is not they will owe something in the future, that it is now that they do currently owe and are obliged to make good on that. Equity is the residual interest in the assets of the entity after deducting all of its liabilities. It is not defined in as of itself. It is simply the difference between assets and liabilities. Looking at income, income are increases in assets or decreases in liabilities that result in increases in equity, other than those relating to contributions from holders of equity claims. So if you have a customer who pays cash for your services, you will have an increase in assets, and that is not due to an equity contribution, so it is income. Expenses are just the reverse of that. Expenses are decreases in assets or increases in liabilities, and that results in a decrease in equity. And again, nothing to do with the equity claims. So if you incurred wage costs to help provide those services, you will have a reduction in cash, which is a decrease in assets, and that will affect your equity. And it's not because you paid out distributions to holders of equity claims. So that would be an expense. Dividends, on the other hand, are a distribution to holders of equity claims, and so dividends are not an expense item. So now that we've covered the recap, let's get into it. The accounting equation. It is super important. You've probably seen this sitting around before, because if you look at a statement of financial position or a balance sheet, this is effectively what it is. On one side, you have assets, and these are effectively, if you want to think about it, what the entity is. These are the resources they control, and obviously can recognize on their financial statements. On the other side, on the right-hand side, we have liabilities and equity. And if you think about it, it's kind of who has control or who has sort of a call on those assets. The liabilities are a present obligation, and these are effectively what the entity owes to external parties if for a second we exclude the idea of owners being external. I mean, yes, owners are external, but I suppose they're more closely linked to the entity than debt holders. So we have these liability holders, so the bank, for example, a whole range of other sort of creditors in there that are owed money. They're presently obliged, or the entity is, to make good on these. Those are the liability claims. What is left over once you've paid off all those claims are the residual interest in the assets, and that is the equity, and that is effectively kind of the owner's stake in the business. The accounting equation needs to balance, and that's a really important feature of this whole enterprise. So after each transaction, the accounting equation must be kept in balance. So you can always tell when you've done something wrong because the accounting equation will get out of line. You can't always tell that it's correct, and we'll touch on errors a little bit later on. But after each entry, it must be kept in balance, which means to do this, a transaction has to affect at least two accounts. Can potentially affect more than two, but it has to affect at least two. And this idea of sort of double entry accounting stemmed, accounting has been done for many thousands of years in some form or another. If you go right back, accounting, the records show, was one of, if not the first written language was actually accounting records. But when it came to double entry accounting, this only got codified in 1494 with Luca Pacioli in Italy. Now, there are arguments as to whether or not he was the first one to actually kind of create it, but certainly he gets the credit for it. Double entry accounting has been in place for over 500 years and has worked pretty effectively in that time. So we have this idea of assets equals liabilities plus equity. And if we want to expand it, and it's useful to expand it because we have two other elements, income and expenses, and if we want to add them onto the right-hand side, it's good to do it that way, is equity is increased by income and equity is decreased by expenses. So you add income on the right-hand side and you take away expenses. And effectively, income minus expenses is profit. So if you have assets going up because you've made profit, that effectively means your equity is going up, which makes a lot of sense because then the owners are better off and everyone's happy. So once we kind of worked out that we've got this double entry component, and again, I appreciate we're going through this without looking at some numbers, and when you start looking at some sort of real examples of transactions, it starts to make a lot more sense, and which is what we're about to do. From a transaction analysis point of view, and this is where the rubber really hits the road, the first thing that needs to be done is obviously just read or understand what's going on, that there has been a transaction, and sort of identify the transaction. The second thing is then to determine the dollar amount that's involved. Now, in this particular subject, in many cases, that dollar amount won't necessarily be all that problematic. If you have paid $100 for wages, you have $100 sort of wage expense, for example. But I suppose you can get some quite complicated examples, and then there obviously are a lot of complicated examples out there. Even just layering in things like depreciation on a non-current asset, to actually come up with the dollar amount that is depreciated each period is not necessarily a straightforward decision. So the cash effect is something to be mindful of. The third thing to do is identify which accounts are affected, so the nature of the transaction. And again, in many cases, this can be fairly straightforward, but not always. So if you have, as I said, a wages example, you have a wages expense and cash going out, cash is affected and expense is affected, relatively straightforward. However, if you have convertible shares, if you have, arguably research and development and what the spend and how to demarcate a spending on research and development. Look, right at the moment, obviously there are a lot of drug companies working very, very hard to try to find cures and vaccines and whatnot. The accounting for research spend and the accounting for development spend are very, very different. And that's outside the scope of this subject. But how the accountants in those companies work out, did that particular activity fall under research or under development? That's not always straightforward. And it will have quite a significant, or could have quite a significant effect on the financial statements and the profitability of the business. And then to finish up, just check that everything balances. And then there might be some final error checking that goes in. Getting into it. So this example here, this is just the first 4 transactions of this particular organization. We will have a more fully built out example looking at the financials and all the rest of it there'll be links to that and whatnot. But in this, we're just getting the sense of what it is, because we've talked about it and it's useful to actually see how it works in practice. So the first transaction on the 1st of September is that Nicholas contributed $20,000 cash into the business bank account. 3rd of September, the business purchased an iPad for $500 cash from JB Tech Supplies. On the 4th of September, the business sent an invoice to Tennis Queensland for services rendered of $3,000. And on the 5th of September, the business banked cash received from coaching services of $10,000. So the worksheet. So the first way to go about doing is a worksheet. Now this isn't generally how it gets done, but it's a good starting point just to get your head around kind of what needs to happen. So on the 1st of September, so the first step is to read and understand the transaction. So on the 1st of September, Nicholas contributed $20,000 cash into the business bank account. Second part is to work out the amount, $20,000, so that's relatively easy. The third is to work out what accounts are affected. Now we have a person or the owner outside of the business contributing cash into the business. So this means from the business's point of view, the business has additional assets of $20,000. So we have an increase in cash of $20,000. So we've got cash assets, accounts receivable, equipment, which is an asset, and capital, which is equity. So that cash has gone up by $20,000. And because the owner has put in, so it's an owner contribution into the business, the other part is equity. So that's the $20,000 equity, his contribution. So it's an external party. Again, assets equals liabilities, of which there are none. So assets equals liabilities, which are none, plus equity. Assets equals equity. Everything's even. On the 3rd of September, the business purchased an iPad for $500 cash from JB Tech Supplies. $500 is the amount. Now, trying to figure out what's happened here. Cash has left the organization. So they purchased an iPad for $500 cash. So cash has gone out, but they now have an iPad. Not really an expense item. It's going to be something which can get reused over a period of time. So it would be classified equipment or something similar, but more importantly, it is a type of asset rather than being an expense. So we have equipment of $500. An asset goes down, an asset goes up. On the asset side, nothing changes and everything balances still. On the 4th of September, the business sent an invoice to Tennis Queensland for services rendered of $3,000. So the services have been rendered. So they have performed work for this, which means the invoice that they've sent, they currently have an economic benefit because Tennis Queensland owe them that money. They have performed the work, I'd imagine, this is all legally binding and whatnot, so that Tennis Queensland owe them that money, and if they fail to pay, they would get into some level of trouble. So that means there is an asset which shows up on the left-hand side, accounts receivable. They don't have the cash yet, so it's not here, but it turns up in accounts receivable, so still an asset. And it is included in capital. We've been a little bit, not lazy, but just to kind of collapse things and make it a little bit simpler at this point, is that this is income. And so it does increase equity. And we see it crop up over here. So this isn't a contribution by the owner, but this is an equity increase because they have earned income. And finally, the business banked cash received from coaching services of $10,000. So obviously they performed some work and they got cash for it, which is why we see the asset go up by $10,000. They provided service. This is income. And so equity goes up by $10,000 and everything still stay balanced, which is exactly what you want. And when we add up the columns in the worksheet, we end up 29,500 for cash, 3,000 for accounts receivable, 500 for equipment, and 33,000 for capital. Assets all added up gives you 33,000. Equity all added up gives you 33,000. Everything balances. So, it's a nice way to be. We don't generally do this when there are a large number of transactions and a large number of accounts. And most organizations, and we're going to see a chart of accounts in a few moments' time, have tens of accounts, hundreds of accounts, potentially thousands of accounts, and to do them all across, all across horizontally wouldn't be that easy to manage. So what we do instead is use sort of a ledger and a sort of journal and ledger system to effectively and efficiently capture this accounting information. And to be fair, a lot of that journal and ledger kind of methodology is done automatically. So once you have identified and kind of put the transaction in, it will flow through the system pretty much automatically. But it is useful to understand how that works. But before we get into that, very quickly, it is useful to touch on debits and credits. And what debits and credits are literally just refer to left and right. They don't mean, one, debit doesn't mean increase, doesn't mean decrease, credit doesn't mean increase, doesn't mean decrease. They simply mean left and right. Now, certain accounts will increase with a debit, certain accounts will decrease with a debit. So the way we think about this, we start with assets equals liabilities plus equity plus income minus expenses. And just for this purpose, we move expenses to the left-hand side. So we end up with assets plus expenses equals liabilities plus equity plus income. Everything on the left-hand side increases with debits. So assets and expenses, if we're using the debit and credit methodology, increase with the debit and they decrease with the credit. Liabilities, equity, income are on the right-hand side, which means they decrease with a debit and they increase with a credit. This is only, it is useful. You'll see it if you delve into the accounting systems. They will actually talk about debits and credits. And so, if you're using kind of the MYOBs and zeros and whatnot, and you have to sort of get behind the scenes, it is a useful thing to know what they mean. But realistically, for this particular subject, we don't go into a huge amount of detail with them. If you're doing an accounting degree of some nature, or if you're thinking about doing an accounting major, you will need to know these in a little bit more detail. And what we will do is have an additional video which just explains this in a little bit more detail. And that's obviously only relevant really for those who need that background information as they move into their later sort of intermediate accounting subjects. But to touch on kind of why that is, when we see it in the journal, we see this idea of debits and credits. And so again, like we do touch on it, it's not a huge part of what we do. Far more important for the MPA type students and the accounting students. So we see the first transaction, and just before we even look at the transaction, let's think about what a journal is. Now, every so often, I suppose it's probably been twice in my life, have tried to keep a journal or a diary, and I am really bad at it. I can't really sit there and write about what happened in my day and, what my thoughts and feelings are. Maybe that's a failing on my part. I don't know. But it hasn't really worked for me. But if you think about what a journal is, it is a chronological listing of kind of events which have taken place. And that is what a journal is in an accounting sense. It is simply going down the page of all the things which have happened. And prior to computing technology, if you look on the right-hand side, that's how it got done. It would literally be writing in a journal all the transactions that happened in sequential order. Now that, if you're looking at that, unless you aggregate that information, it's not that useful, but it does allow you to aggregate the information. So there is a purpose to it. And the way it gets set up is if you have an account which requires a debit, you debit it. If you have an account which requires it to be credited, you credit it. So in this first entry, we have cash, which is an asset increasing in the business, and assets increase with a debit. So the cash asset here gets debited 20,000. We also know we have capital, and that increases, and capital is on the right hand side, and capital increases with a credit. And so we have the debits in the transaction equaling the credits in the transaction. Life is good still. Again, that's all we'll do in terms of showing journal entries in this particular video. But as I mentioned, there will be another fuller video that goes through a worked example in more detail. The ledger is an account that accumulates all the information about changes in specific account balances. Look, it can be used in place of a journal, but it's often used together, because what ends up happening is the journal provides this huge list of all the individual transactions which take place, which, are useful to have. I mean, very useful to have, but it doesn't give you a lot of information, to do anything with it. You need to be able to aggregate it first. So kind of, if you think about your bank balance or your bank statement, if you were to look at your bank statement and look at all the entries that take place, but not have an account balance running along the side, or the end of month or end of year balance at the bottom, it's really hard to understand exactly what's going on. Could be your credit card statement and looking at all the transactions which have taken place. It's only when you aggregate that information and get those totals where you can actually kind of understand how much you owe at the end of the month. So the information from the journal, all those various transactions, gets posted to the ledger, and what you end up with is, so this is the first transaction, the cash coming in. We have office equipment, we have the coaching fees and the rent. It's a different transaction in this particular one, but obviously, we can figure that out. And what we end up with is a balance of 28,500. And so again, we kind of get to a point where we know at the end of that particular month, that's how much cash there is. The ledger account has a debit side and a credit side, left and right. The chart of accounts is just simply a listing of the ledger account titles. So this is where they all get kind of listed down. They can be done in a manual system or in a computerized system like your zeros or your myobs or whatnot. And you can certainly, add accounts to them. And just to give you an example quickly. So what we have here is the chart of accounts for an organization, and this is in Xero. And what we can see as we scroll down, there's revenue accounts with 200 codes, expense accounts with 400 odd codes. There's a few. Current assets, 600 codes, fixed asset, 900 codes, so non-current assets. Your liability codes all have 800s, equity 900s. So, again, there's like lots of opportunity to expand and add items in there, but it's a place where you can see what the different ones are. So, chart of accounts. The trial balance is then taking all the ledger accounts, and there could well be hundreds of these things, and listing them down. And this just helps in the preparation of financial statements. Certainly when you're doing it in a manual sense, when you're doing it through something like a Xero or Maya, it's less critical because you can just basically create these reports without having to go from the trial balance. But it's also good just to check that everything seems to be right in one central place. So we can see in this particular example here, we've got a number of accounts with debit balances equaling 33,000 and a number of accounts with credit balances equaling 33,000. And doesn't mean, just because they balance doesn't mean that you're correct, but it certainly, if they don't balance, you can absolutely be sure that you have made a mistake. And speaking of mistakes, there are a number of which are in there, and they could be single entry errors. So you could enter one line of the transaction, not both. And if that's the case, the worksheet just won't balance. And often in a lot of the computerized ones, you can't even do that. Like it requires it to be in two. If there is a transposition error, this is more likely to happen. So if you have two digits are transposed, so there might be 5430 as opposed to 5340. Really easy to make. Interesting factoid: transposition errors are always divisible by 9. If you don't believe me, go and try it. I certainly spent a little bit of time doing so. Finally, just there's incorrect entries. So do you record 2 increases or 2 decreases on the one side? So you haven't balanced it out properly. Or have you recorded an increase to one side and a decrease to the other side? So there's an owner withdrawal of cash of $3,000 and records it as an increase in cash and a decrease in equity. So if everything still balances, you're probably then going to have to rely on additional information. So, reconciliations, for example, with the bank statements to check that, everything seems to line up. But it can be kind of hard to tell. There may be sort of hunches involved with what you're looking at, but if you're dealing with a large organization, that's probably less likely. So it's maybe working off other information to help identify, to sort of provide evidence of what the balances or what the amount should be. So in summary, we looked at business transactions, we looked at the accounting equation, debits and credits, transaction analysis, a worksheet, journal, ledger, trial balance, and a final wrap up on accounting errors. So again, that's just a general overview. If you have questions, please use the various discussion boards and please get in contact with us. There is going to be another video which steps through an example in a little bit more detail. So if you really want that sort of walkthrough effect, there'll be an opportunity to look at that. And also for those interested in more the debits and credits side of things, there'll be information on that for those that need it. Otherwise, thank you for your time.